With Friday's close last week, we had one of the four occurrences of our triple witching Fridays that we see every single year. This was the September expiration, with all of the options expiring on September 17th, 2021. In today's video, what I'd like to do is focus in on the futures and stock volatility we saw in the entire week leading up to September 17th, 2021. So that's going to be all the way from 9/13 all the way up till the actual date of expiration, which was the 17th. Now, for those of you that are unaware, Triple Witching Friday happens 4 times a year, and that's when all of the stock options, all of the stock index futures, along with all of the stock index options all fall on the same day, meaning there's triple expirations, aka triple witching. Now, this happens 4 times every single year. The first two have already passed behind us. The first was March 19th, 2021. That one's already passed. The next one is June 18th, 2021, also behind us. And now our most recent one that we had just a couple days ago was September 17th. Now, my goal of this video is less to try and tell you what to do next triple expiration, but more so try and understand what happened this time around. Take a look at the data, understand the volatility, use that to really just start to get a better understanding of the triple witching Friday phenomenon and how we can maybe look at taking advantage of it in the future. Now, starting off, let's focus in on the stock volatility, and we'll start by understanding how volatility looked like across the week. Now here I have a chart with the number of trades that occurred off of our live scanner. These are trades that were on our live scanner for at least 3+ minutes, meaning you had some sort of an opportunity to actually get inside and participate in these volatility breaches. And the second factor of this is that the trades occurred all the way up until 10 a.m. Pacific. Any trades after 10 a.m., we construed that we don't have enough time for follow through, and we ignored those. So using both of these two statistics, if we take a look, Monday very clearly had the most volatility throughout the week. We had 127 different triggers off of our live scanner. Then we came into Tuesday where that number dropped substantially. We dropped all the way down to just 27. On Wednesday, we had 63 triggers. Then on Thursday, 58. And then finally into the actual expiration day, a little bit more volatility, 73, but still nowhere as close to what we saw on Monday. So the takeaway here that I thought was a little bit more interesting is Monday is where, at least this week, we had the most volatility, where it was almost double that of even Friday's volatility. For most of the week, we were, like, say, if you compared this to Tuesday, you'll notice 27 compared to 127, a drastic difference. But even when you compare it to Friday, 73 versus 127, fairly substantial difference where it was very clear that Monday was the more volatile day, at least of this triple expiration week. Now we'll see if that continues, but let's look at a few different ways to try and splice this data up further. The next is, let's do a deeper dive into Monday since that's where we had the most triggers. Now I have two different splices here. One is by hour of day, where I've gone all the way up until the market closes, and then the second is time and trade. Now using our hour and day, you'll notice that the 7 to 8 a.m. mark was the most profitable hour on Monday. Positive P&L there of $8.85. As long as we see a number above zero, that means it's a good sign. Number below zero, like you see in 10 a.m. to 11, along with the final hour of the markets, that's a bad sign. So the whole notion of ignoring the final parts of the day, anything beyond 10 a.m., is really to avoid exactly this. We'd like to give our trades enough time for a follow through, and the data here, at least off of Monday, shows us that any trades before 10 a.m. were more likely to succeed than those after 10 a.m. So that's splice number one. Now splice number two in this is the time and trade. So if we look at trades, say less than 5 minutes, you'll notice the P&L here is still above zero, but fairly close to zero. And that's what we sort of expect. There's a lot of hitting our volatility breaches and then bouncing right away, or conversely going outside of the clouds, getting you to a stop out. Now I'm not going to go into charts in this video, but if you're curious about the setup, I'll leave a link to an example video in the description box below that really measures what is this time and trade actually measuring. Now next up, we have 5 to 15 minutes, which was a nice sweet spot. Positive P&L there of $5.35. That's what we like to see, and this is very much in line with what we're used to see. 5 to 15 minutes has been the sweet spot. This time that extended even beyond 15 to 30 minutes with another positive P&L. And then as soon as you started to give the trade much more time, 30 minutes plus, anything even 60 minutes plus, you'll notice the trade started to go negative in terms of expectancy. So here, the takeaway that I would have is, again, our 6 to 10 a.m. mark, which is part of our rules, is the nice spot that we'd like to be in between. 9 a.m. to 10 a.m. is the final hour. Anything after 10 is where things start to get negative. In terms of time and trade, less than 5 minutes, a little bit mediocre, but 5 to 30 minutes, this range right here, a really nice range. And this is again in line with the data that we've been used to seeing so far every time we've done this test. Now, the third and final way that we can break up stock volatility is looking at the week in aggregate. Now, I have the percentages here broken down for the 4 different models that we have. We have 2 sets of models, an aggressive and a conservative model, and inside each of those models, we have long opportunities along with short trade opportunities. So 4 different model types, or trade types rather, in general, and we have the same trade counter right here for Monday, Tuesday, Wednesday, Thursday, Friday. Let's review each of these just row by row. So on Monday, we already discussed we had 127 trades, but I think the more important part here is what was the win rate. So Monday, aggressive long. So this is our aggressive volatility box model, and looking for just long entries, meaning price is falling into our levels, and we're looking at trying to buy the dip. We had a 53.38% win rate. Using our aggressive short, a 55.56% win rate. Using our conservative long, which is if price action goes even outside of our aggressive, a 53.19% rate. And using our conservative shorts, 68.75%, the greatest one, at least in terms of Monday's activity. So using Monday's row, the one thing that stands out to me is across the board here, we were above 50%, which I think, again, a good positive sign, something that doesn't necessarily happen. We'll see buyers, sellers mix and match, but on Monday, it was fairly balanced where our models actually gave us a very good indication of which direction the market is likely to go after hitting our volatility ranges. Now, Tuesday came around, far fewer opportunities, 27 trades, or 27 triggers only. Now, aggressive long there, 50%. Aggressive short below the 50% mark at 38.89%, but coming right back into our conservative long, 55.56%, and our conservative short, 66.67%. So far, our conservative models Monday and Tuesday have been nice models in which our conservative shorts even greater than a 60% win rate. That's what we like to see. Now we head into Wednesday. There we had 63 trade opportunities. Our aggressive long here was above that 60% mark at 61.54%. Our aggressive shorts, 37.70. Conservative longs, 54.55, and 55% for the shorts. So yet again, so far, 3 days in a row, you can see how the conservative model gives you a better opportunity to try and time a reversal, considering that the market and price action in whatever equities, ETFs, whatever it is you're looking at, has fallen substantially where we now have a pivotal point. Now we move on to Thursday. Thursday, 58 trades. Our aggressive long here dipped slightly below 50%, 45.10%. Our aggressive short, 67.44%. So you'll notice Wednesday and Thursday almost flip-flopped in terms of what we expected from our models. Now we move on to our conservative, 66.67% for our conservative long. And the first time we had our conservative short dip below that 50% mark at 33.33%. And then finally, the actual expiration day, September 17th, 2021, the Friday, the day that triple witching actually occurs. 73 total trades. Aggressive long was 51.80% in terms of a win rate. Aggressive short, 56.67%. Conservative longs here dipped below the 50% mark at 44.19%. And finally, conservative shorts at 60%. So across the board here, if we were to try and now compare a blended average, here's what you would find. Using our aggressive long models, Monday through Friday, we had a winning rate of 52.36%. So again, above the 50% mark, what we'd like to see. For aggressive shorts, 51.25%, again, above the 50% mark, what we'd like to see, good sign there. Conservative longs, above the 50% mark as well, 54.83. And finally, conservative shorts, 56.75%, again, both of which were above 50%. So across the board here, Monday through Friday, across the 4 different models we have, our win rate was above the 50% mark with a few dips in between, along with a few moments in which we were, say, fairly close to that 70% win rate, like on Monday. So this is how the stock volatility broke down for the triple witching week. Now if we move on to our futures volatility box and try and repeat something similar, this is again going to be for all markets, and I'm using the morning volatility node. Again, I'll leave a link in the description box if you're unfamiliar with the concept, but we're using that to try and understand the volatility now across the board. So here I have the S&P, then the Nasdaq, then the Dow, then the Russell, then the 30-year note, then we have crude, natural gas, and copper, and then finally gold and silver. Now, each of the different colors represents the day of the week. So Monday is green, Tuesday is the lighter blue, Wednesday is yellow, Thursday is the darker green, and finally Friday is the darker blue. And the key is also available right here. So you'll notice the axes on the left-hand side, the y-axis, has a 0, 1, 2, 3, 4, 5, and 6. A 1 implies we were on our scalper volatility box models, meaning we saw less volatility in the markets, we were much more aggressive. A 6 implies we broke outside of even our doomsday conservative models, which are the most conservative models that we have. So anything where we have a 6, we have NA, and you'll see that that happened 2 times really across the week, once in the 30-year bond on Tuesday, and then 2 times in natural gas, which was fairly volatile throughout the week. Now let's try and use this to actually understand how the week progressed. So in the S&P here, the way I would really read this chart, is we started off the week with little volatility, and volatility really entered the market as the week progressed. That was the S&P. However, if you then contrast that with the Nasdaq started with fairly high volatility, started to lose volatility as the week progressed, with Friday being that one peak point in which the data spiked up just a little bit. Now we take a look at the Dow. The Dow is similar to the S&P here, where the Dow progressed very systematically in volatility as we progressed through the week, all the way up until Friday, where that volatility seemed to just disappear out of the markets, at least leading up to 7:25 a.m., where we were still off of our scalper models. Now, for all of our volatility box members, you should have noticed this, where on the Dow on Friday, we were on the scalper, but in the Nasdaq, we were off of our conservative volatility box models, and in the S&P, also off of the conservative, which you can see with being at the 4 mark, which is, again, that same conservative note. So the S&P, the Nasdaq, much more volatility on Friday compared to the Dow. Now, if we move on to the fourth and final index market here, the Russell all across the board, really all 5 days of the week here, had much lower volatility than really many of the markets that we saw across the board. The only other market that comes close to the Russell was crude oil, in which most of our volatility inside of crude stayed contained within our aggressive volatility box model, which you can see with these histogram bars being at that 2 axes level. So that's S&P, Nasdaq, Dow, Russell. Russell had the least volatility. S&P volatility increases the week progressed. Same thing with the Dow outside of Friday. And the Nasdaq started off Monday with the splash and then lost a little bit of volatility up until Friday. Now let's move on to natural gas here. Natural gas, Monday, Tuesday, fairly contained volatility, but then Wednesday, Thursday came around, and by 7:25 a.m., we knew that natural gas is just not a market we care to trade, didn't meet any of our models, and we far exceeded price action inside of those models. Now came Friday, though, and that volatility returned right back to the level that we were used to seeing on Monday and Tuesday. So I thought that was a very interesting note that happened inside of natural gas, where we really had a nice spike in volatility, and that spike really lost most of its volatility into the close. Next up, we have copper. Copper was much more volatile when you compare it to something like, say, crude, a little bit less volatile when compared to natural gas, but we had 3 different spikes here. That was Monday, Tuesday, and Friday, in which we exceeded beyond the aggressive volatility box models, where we actually breached all the way up to our doomsday conservative models. Level 5, really the last level that we have available to us. So that was the energy. So we so far have discussed the indices, the 30-year bond, crude, natural gas, copper. Finally, we had gold and silver, which if you just take a look at the spikes here, gold and silver really systematically across the week had more volatility than we're used to seeing. Typically inside of gold and silver, we'll see price really hover right around this 1 axis level, or we're really, rather, using layman's terms here, using the scalper models. Instead, this past week with triple expiration, that's not necessarily to say correlation equals causation, but more so an observation. Monday, less volatility compared to usual, but Tuesday and Thursday, much more volatility than we're used to seeing. Now, if you were to compare gold to silver, you'll notice that silver here on Tuesday, we had that same volatility zone, but on Thursday, that volatility exceeded even that of gold. So silver was much more volatile, and you can see that in Thursday along with Friday's activity, where we're exceeding one level above what we're used to seeing inside of gold. So now if we try and summarize the noteworthy observations that we've captured in both the stock and futures volatility box models, the Nasdaq started with the most volatility for the week out of the four major index markets, but the Dow and the S&P really took over as the week progressed, and the Russell was the one outlier where we had very little volatility. And for those of you looking to try and participate in places where there's less volatility than usual than the other markets, the markets in which something's a bit calmer, the Russell was definitely it this past week. Now, second, gold and silver around the futures market had higher volatility than usual for a majority of the week, and silver in particular, compared to gold, had more volatility when we compared Thursday and Friday. So silver a bit more volatile than even gold. Now, if we move on to stocks, Monday here had almost double the volatility inside of the stocks compared to the rest of the week. The sweet spot for trade time, as we've discussed, was between that 5 to 30 minute mark, where traditionally we're used to seeing 5 to 15 minutes. This time around with triple witching, we could expand that even beyond that 15 to 30 minute mark. Anything beyond 30 minutes, we started to see the win rate drop down a little bit. And finally, the average win rate percentage for the week, really across Monday, Tuesday, Wednesday, Thursday, and Friday, were all greater than 50% across all four models, especially when you look at things in terms of an aggregate basis for all trades, probabilities on the aggregate as opposed to focusing in on any single trade or any single day of the week. The whole idea here is to have a zoomed out approach and understand it for what is volatility in the markets and how we can systematically take advantage of it using probabilities along with our volatility models. All right, so I hope this video was helpful. Whether or not you're a Volatility Box member, I hope this at least helps for you to understand how volatility progressed in the week, especially during the week of Triple Witching Friday. If I go back all the way to the first slide here, we have one more day coming up for Triple Witching, which is going to be December 17th. So perhaps some of this data helps preparing ahead of December 17th, or at the very least, we can try and repeat the same exercise near that December time period to understand was the same pattern still prevalent inside of the markets. All right, take care, everyone. Good luck trading, and we'll see you in the next update.